How did a brilliant finance professor go from making 35% annual returns for 15 straight years, becoming George Soros' most trusted partner, only to lose everything twice in spectacular fashion, forcing him to sell his prized antique silver collection and mortgage his mansion both times? Victor Niederhoffer's story is one of the most tragic tales of brilliance and hubris in financial history. But this video is also a journey through the dangers of excessive risk-taking, the illusion of invincibility, and why even the smartest people on Wall Street can be destroyed by their own success. And trust me, this story is absolutely devastating. Welcome to the rise, fall, resurrection, and second fall of Victor Niederhoffer. The story of Victor Niederhoffer begins in a surprising place: Brooklyn, New York, in 1943. Born to a Jewish family, Victor's father was a New York City police officer who later became a sociology professor. His mother was an English teacher. They weren't wealthy, but they valued education above everything else. Growing up in an immigrant neighborhood in Brooklyn, Victor was quiet, bookish, and intensely competitive. He read constantly, analyzed everything, and had an almost obsessive need to be the best at whatever he attempted. But young Victor had no idea what that would be yet. In 1960, Victor arrived at Harvard University as a freshman. He was brilliant academically, studying statistics and economics, but something else caught his attention. He noticed students playing a game called squash, a sport he'd never even heard of before. Most people would watch for a while, maybe take some lessons, slowly work their way into the sport. Not Victor Niederhoffer. He walked up to other students and made a bold declaration. Within 4 years, he would become the greatest squash player in America. People laughed at him. This kid from Brooklyn, who'd never held a squash racket, was going to become a national champion. Impossible. But Victor had already learned something crucial about himself. When he set his mind on a goal, when he studied the patterns and probabilities, when he outworked everyone else, he could achieve things that seemed impossible. And incredibly, he did it. By the time Victor graduated from Harvard in 1964, he had won the National Intercollegiate Squash Championship. Over the next decade, he would win 5 U.S. National Squash Championships. He used cunning, strategy, and sheer willpower to overwhelm opponents who were faster and fitter than him. But squash was just the beginning. Victor's real passion was understanding markets. He went on to get his PhD in economics from the University of Chicago in 1969 and became a finance professor at the University of California, Berkeley. And this is where Victor Niederhoffer started to change the world of finance. As a professor in the late 1960s and early 1970s, Victor became obsessed with a question: were financial markets truly efficient and random, as most economists believed? Or were there patterns, anomalies, predictable behaviors that could be exploited? Victor started writing academic papers that challenged conventional wisdom. He analyzed stock market data looking for inefficiencies. He studied how news events affected stock prices. He examined the behavior of market makers and specialists on the stock exchange floor. His 1966 paper, Market Making and Reversal on the Stock Exchange, was groundbreaking. It made Victor the father of statistical arbitrage and market microstructure studies. He was identifying patterns in market behavior that other academics insisted didn't exist. But Victor wasn't content to just write papers. He wanted to prove his theories worked in the real world. In 1980, he founded his own trading firm, NCZ Commodities, later known as Niederhoffer Investments. And from the very beginning, Victor's approach was different from everyone else. He used quantitative analysis and pattern recognition before most people even knew what those terms meant. He looked for statistical anomalies, moments when the market was behaving irrationally, and he bet against the crowd. The returns were spectacular. Victor was making money consistently, year after year. His reputation grew. And in 1982, one of the most famous investors in the world came calling. George Soros, the legendary billionaire hedge fund manager, had been watching Victor Niederhoffer. He was impressed by Victor's intellect, his discipline, his ability to find profitable trades that others missed. So Soros made Victor a partner and put him in charge of managing all fixed income and foreign exchange trading for the Soros Fund. This was an enormous vote of confidence. George Soros didn't trust many people with his money, but he trusted Victor Niederhoffer completely. In fact, Soros held Victor in such high esteem that he sent his own son to work for Victor to learn how to trade. For 8 years, from 1982 to 1990, Victor managed billions for Soros and generated exceptional returns. Soros would later say in his book, The Alchemy of Finance, that Niederhoffer was the only manager who retired voluntarily from trading for him while still ahead. By 1990, Victor decided it was time to focus entirely on his own fund. He left Soros on excellent terms and threw himself into building Niederhoffer Investments into one of the premier hedge funds in America. And for the next 7 years, Victor Niederhoffer went on one of the greatest runs in the history of speculation. From 1990 to 1997, his funds averaged returns of around 30 to 35% per year. Let me repeat that. 30 to 35% annual returns for 7 consecutive years. In 1994, Businessweek named him the best U.S. commodities fund manager. In 1996, he was ranked the #1 hedge fund manager in the country by MAR Hedge, a respected tracking service. His picture appeared in the Wall Street Journal, Businessweek, even the National Enquirer. Victor was managing $130 million, and much of it was his own personal fortune. He bought a beautiful mansion in Connecticut. He filled it with an incredible collection of antique silver, one of the finest private collections in America. He had 6 daughters, a successful career, and seemed to have it all figured out. His clients loved him. His returns were so good that people begged to invest with him. Victor Niederhoffer had reached the pinnacle of the hedge fund world. He was wealthy, respected, and by his own admission, he believed he had achieved the greatest run of success in the history of speculation. But beneath this success, Victor was developing a dangerous habit. He was taking bigger and bigger risks, and he was starting to believe in his own invincibility. By 1997, things started to change. The market was becoming more efficient. The easy trades were harder to find. Victor's fund was having trouble finding the same opportunities that had generated such spectacular returns in previous years. So Victor started looking elsewhere. He began investing in areas where he didn't have as much expertise. And this is where everything started to go wrong. Victor became interested in emerging markets, particularly Thailand. He didn't know much about the Thai economy. He'd never been there. But a friend told him that the brothels in Bangkok were cleaner and safer than before. Victor thought this was a sign of economic development. So based on essentially no real analysis, Victor bet heavily that Thai bank stocks would recover from the Asian financial crisis. He sold put options on these stocks, collecting premium and betting that the Thai government wouldn't let the banks fail. But Victor was wrong. Thailand's financial crisis got worse, not better. The Thai baht collapsed. Thai banks were in serious trouble, and Victor's position started bleeding money. By August 1997, he'd lost nearly half of his $130 million fund. Most traders would have cut their losses at this point, admitted the mistake, gotten out of the position, lived to fight another day. But Victor Niederhoffer wasn't most traders. He was competitive to his core. He couldn't stand the idea of being beaten by the market. So instead of cutting his losses, Victor doubled down on another huge bet. He sold massive amounts of put options on the S&P 500 index. Essentially, he was betting that the US stock market wouldn't drop significantly. He collected premium from selling these options, and as long as the market stayed stable or went up, he would pocket the money. But here's the problem with selling put options. Your maximum gain is limited to the premium you collect, but your maximum loss is theoretically unlimited. If the market crashes, you're completely exposed. And Victor had sold an enormous amount of these puts, far more than any reasonable risk management would allow. For a few weeks in October 1997, Victor's bet seemed to be working. The market was stable. He was collecting premium. Everything seemed fine. But Victor had a feeling something was wrong. He was ice skating one weekend and suddenly started shivering. He later said he felt like the Grim Reaper was behind him, reaching out with a scythe. He knew that if all the forces aligned against him for one more day, it could lead to an avalanche. And then on October 27, 1997, the avalanche came. The Asian financial crisis finally spread to U.S. markets. The Dow Jones Industrial Average fell 554 points in a single day, a decline of 7.2%. It was the 8th largest point decline in the history of the index. For Victor Niederhoffer, it was catastrophic. The put options he'd sold suddenly became enormously valuable, and he owed far more money than he had. His brokers called demanding he put up more capital to cover his losses. He needed to come up with $50 million immediately. But Victor didn't have $50 million in cash. His wealth was tied up in his house, his silver collection, his fund. He scrambled desperately to raise money, calling everyone he knew, trying to liquidate positions, but it was too late. The brokers started liquidating his positions for him, selling everything at terrible prices in a panic market. And because Victor had used so much leverage, had taken such concentrated positions, the losses were total and complete. By the end of that day, Niederhoffer Investments was finished. The $130 million fund was gone. Victor's personal fortune, built over 15 years of brilliant trading, evaporated in a single day. He was not just broke. He was deeply in debt. Victor had to mortgage his mansion to raise cash. He had to sell his beloved antique silver collection, piece by piece, at auction. Collectors came to his house and took away the treasures he'd spent years accumulating. It was, in his own words, like a death. The man who had been ranked the #1 hedge fund manager in America just months earlier was now being dismantled by his creditors. The financial press, which had celebrated his genius, now wrote obituaries for his career. Wall Street analysts said it was sheer hubris. That Victor had confused being right in the long term with being right all the time. But perhaps the most painful part wasn't the money. It was the humiliation. Victor had always been intensely proud. He built his entire identity around being smarter than everyone else, being the champion, being the best. And now he'd been destroyed, publicly, spectacularly. Victor spent weeks in a kind of shock. He had a wife and 6 daughters who depended on him. At 54 years old, he'd lost everything. Most people would have retired, moved away, tried to forget the whole thing. But Victor Niederhoffer wasn't built that way. He'd proven everyone wrong before when he became a squash champion. He'd built a fortune once, and he was determined to do it again. So in 1998, just months after the catastrophe, Victor started over. He mortgaged what was left of his house and started trading again, this time with his own small account. He called the new fund Wimbledon after the tennis tournament because he was hoping for a comeback. He went back to fundamentals. He rethought his entire approach. He modified his pattern prediction programs. He became more disciplined about risk management. And slowly, painfully, Victor started making money again. By 2002, Victor had recovered enough to launch a new fund called Matador. He kept it small initially, around $50 million, managing mostly his own money that he'd earned back through careful trading. And incredibly, Matador started generating the same kind of spectacular returns that had made Victor famous in the first place. In 2002, Matador returned over 40%. In 2003, another 40%. Year after year, Victor was proving that his 1997 collapse had been a fluke, a one-time disaster, not a fundamental flaw in his approach. By 2006, Matador was managing $156 million, and Victor was being invited to exclusive hedge fund conferences again. He appeared at an evening event at New York's St. Regis Hotel in April 2006, walking under gilded candelabras in a lavender blazer, feeling like he'd returned to the top of the world. The comeback was complete. Victor Niederhoffer had risen from the ashes, but there was a problem. Victor hadn't actually learned the most important lesson from his 1997 collapse. He was still using the same strategy: selling options, collecting premium, betting on market stability. And he was still using too much leverage. From 2003 to 2007, financial markets had been remarkably calm. Stock prices went up in a fairly straight line with only minor corrections. This calm environment was perfect for Victor's strategy. Selling options on a stable market is incredibly profitable because you collect premium and the options expire worthless. But Victor was making the same mistake again. He was confusing a period of low volatility with permanent stability. He was increasing his leverage, taking bigger and bigger positions, because everything had been working so well for so long. And then, in 2007, the subprime mortgage crisis began. At first, it seemed like a problem limited to a few specialized lenders. But by the summer, it was clear something much bigger was happening. Bear Stearns announced that 2 of its hedge funds invested in subprime mortgages had lost almost all their value. Financial markets, which had been so calm for years, suddenly became violently unstable. Volatility spiked. Stock prices started swinging wildly. And Victor Niederhoffer, who had sold enormous amounts of options betting on continued stability, was in serious trouble. He tried to hold on. He told himself this was just temporary, that markets would stabilize, that he'd survived worse before, but this time was different. The crisis kept getting worse. Volatility kept increasing, and Victor's losses kept mounting. By September 2007, the Matador Fund had lost more than 75% of its value. Investors were demanding their money back. Victor had to close the fund. And once again, much of the money lost was his own personal fortune that he'd spent nearly a decade rebuilding. Victor Niederhoffer had blown up twice, both times using the same strategy, both times with excessive leverage, both times selling options in markets that seemed stable until they suddenly weren't. The second collapse was in some ways even more devastating than the first. After 1997, people could say Victor had made a mistake but was still fundamentally brilliant. After 2007, it was harder to defend him. He'd had a second chance and made the same errors. The pattern was clear. Victor Niederhoffer was a brilliant analyst but a terrible risk manager. In interviews after the second collapse, Victor admitted he'd been in over his head both times. He said he didn't have enough capital to withstand unforeseen events, that he'd been too vainglorious, that he'd had an incredible string of successes that made him believe he was invincible. He compared himself to someone who goes to Vegas with $10,000 and sets a stop loss at $5,000. Everyone has a plan for when they're losing. But Victor said most traders never have a plan for when they're winning. They never say, "When I've made this much, that's when I'll quit." And Victor had never learned to walk away while he was ahead. So what can we learn from the tragic story of Victor Niederhoffer? First, brilliance and success don't protect you from catastrophic failure. Victor was genuinely one of the smartest people in finance. He had a PhD from Chicago. He pioneered statistical arbitrage. He worked for George Soros. He generated 30% annual returns for 15 years. And yet he still managed to lose everything twice. Intelligence alone isn't enough. In fact, Intelligence can be dangerous because it makes you confident in your ability to analyze risk. Victor always believed he understood the probabilities. He thought he was making calculated bets with acceptable risk. But he was wrong about the risk, both times. Second, past success can become your greatest enemy. After 15 years of spectacular returns, Victor started to believe he was different from other traders. That normal rules didn't apply to him. That he could take risks others couldn't because he was smarter, more disciplined, more experienced. This is the trap that destroys so many successful traders. The very success that makes you rich also makes you overconfident. You start to attribute your wins to skill and your losses to bad luck. You stop questioning your assumptions. And eventually, you take a risk that destroys you. Third, leverage is dangerous even when you're right in the long term. Victor's core thesis was often correct. Thai banks did eventually recover. The S&P 500 did eventually go up. But being right in the long term doesn't help you if you get wiped out in the short term. When you use leverage, you're racing against time. You need the market to move in your favor before your margin calls come due. And if you've used too much leverage, even a temporary move against you, even if you would have been proven right eventually. Fourth, selling options is particularly dangerous because the risk-reward is so asymmetric. When you sell options, you collect small premiums over and over, and it feels like free money. But you're essentially picking up pennies in front of a steamroller. Most of the time you collect the pennies, but occasionally the steamroller runs you over. Victor collected premiums for years. But twice, the market moved against him dramatically, and those small premiums he'd collected were nowhere near enough to cover the catastrophic losses. Finally, Victor's story shows that you can be completely destroyed twice and still keep going. After his second collapse in 2007, Victor could have retired. He was in his 60s. He'd proven himself brilliantly. He'd had an amazing career, but Victor kept trading. He started yet another fund. He continued to write, to analyze markets, to share his ideas. Whether this was admirable persistence or dangerous obsession is debatable. But it shows that for some people, the game itself becomes more important than the money. Victor didn't trade because he needed wealth. He traded because it was who he was. Looking back, Victor Niederhoffer's career is almost Shakespearean in its tragic arc. A brilliant mind, extraordinary success, fatal hubris, complete destruction. Then an incredible comeback, more success, and the same fatal hubris leading to a second destruction. George Soros once said that Victor was different from other traders because he was so emotional about his trades. When the market went against him, it was physically painful for Victor to even discuss it. Soros, by contrast, was always calm. He knew that the market would be open again tomorrow, that there would always be new opportunities. But Victor couldn't let go. He couldn't accept small losses. He always believed the market would come back, that his analysis was correct, that he just needed to hold on a little longer. And twice, that belief destroyed him. The writer Nassim Taleb, who knew Victor and greatly respected him in many ways, used Victor as a cautionary tale in his books about risk and probability. Taleb argued that Victor's strategy was like Russian roulette. Most of the time you pull the trigger and nothing happens. But eventually, statistically, the bullet will be in the chamber. Victor's defenders point out that he achieved things that almost no one else has. Multiple comebacks from complete financial ruin, decades of exceptional returns, training numerous successful traders who went on to manage billions, making genuine contributions to the academic understanding of markets. And they're right. Victor Niederhoffer is a giant in the history of quantitative trading. His early work influenced generations of traders. His books, The Education of a Speculator and Practical Speculation, are still widely read. His daily speculations blog became essential reading for serious traders. But Victor's two spectacular failures overshadow everything else. And they serve as a permanent reminder that in financial markets, no amount of past success guarantees future survival. No matter how smart you are, how experienced, how disciplined, if you use too much leverage and take concentrated bets, you can lose everything in a single day. Today, Victor Niederhoffer continues to trade and write. He's in his 80s now. He never achieved the comeback after his second collapse that he managed after the first. But he remains intellectually engaged with markets, still analyzing patterns, still searching for inefficiencies. His legacy is complicated. To some, he's a cautionary tale about hubris and excessive risk-taking. To others, he's a testament to resilience and the pursuit of knowledge. But everyone agrees on one thing. Victor Niederhoffer's story is one of the most dramatic and instructive in the history of speculation. And that's the devastating story of Victor Niederhoffer, the brilliant trader who made 35% annual returns for 15 years, lost everything in a single day, rebuilt his fortune over a decade, and then lost everything again in exactly the same way. A story of genius, hubris, destruction, resurrection. An ultimate tragedy that shows us that in the markets, being smart isn't enough. You also have to know when to walk away.